for people who are like, okay, well, how can I make the stock market work for me? Because obviously how these people get away with doing this is because everyone knows the stock market itself is not a scam. There are ways to make people make fortunes on the stock market. They just don't make it overnight. So I usually recommend that people do things like index funds, just really safe, super low fee strategies, things where you can get 95% of the value, let's say, out of the stock market with basically doing no work at all. That's how I usually advise. How do you, when you look at things, people, average, everyday people who are just like, how do I get the most out of this without basically subjecting myself to extraordinary risk or extraordinary amounts of time that may not pay off for me? Let's just say they don't want to be a professional investor. What do you do with your money? What are your recommendations?
You know, I would advise people firstly to put money away and don't even look at it. Like, so when you invest it, don't even look at it. Like if it's for your retirement, if it's in 30 years time, start looking at it in about 25 years, you know, but just put it, as you say, in a low cost mutual fund, like place like Vanguard or Fidelity, they all provide them, right? If you want to mix it up and sort of use your head a little bit more, like if the purely passive approach doesn't appeal to you, you know, all of those big index fund services provide a bunch of indexes, right? And you can probably improve your diversification by maybe adding like opportunely, like you maybe sometimes, you know, in recent years, growth stocks, you know, all the technology stuff has done really well. In other periods, value stocks, like kind of the more boring companies do well. You know, you might want to, you know, if you feel that you can add value, you might allocate a little bit differently between those rather than just a pure index fund. You might want to, you know, buy an international mutual fund or emerging markets or something like that if you feel there's been a big sell-off in that area, if it makes sense. But that's kind of as active. You know, the stock market is a great thing, and it really is the route to wealth. Well, it can be the route to growing your wealth in that when you invest in stocks, what you do is you own a business or you own part of a business, and you should expect the kind of returns that a business will get. You know, so if you're invested in Amazon, you should expect the kind of returns that Amazon will get or whatever. And so, sorry.
No problem.
So, you know, investing in stocks is a good way of growing your wealth. I think everyone should invest, just to be clear. But I think that you need to do it with an amount of money that doesn't stress you. Like if you are staring at the daily moves, it probably means that you've exposed yourself to too much risk. You know, if you're afraid of it, and just back your size down. There's a friend of mine who is a big fund manager, and he refers to the stock market as being a lot like a casino, but he says you have the great fortune of being on the correct side of the tables, you know, because over the long run, the stock market grows, we'll say at about 5% greater than the risk-free rate or than what you'd earn in bonds, right? And you get to put your money in and be like the house and sort of have the edge in your favor. But then what you do is you just put it in and you leave it in. And often, you know, we all have these faults. We all have urges to do things differently, and they often harm us in the world of investing, you know. And a great example, actually, the same guy, I'll send you a link later, he wrote a paper on a coin flipping game. And it was set up that the students who did it were told that the coins would flip, I think, 60% of the time you'd have heads, right? And you get to bet on it. And he wanted to see how well people bet on this.
Is this a Malkiel argument? Or is this Burton Malkiel?
No, this is his name. He's actually one of the partners from Long-Term Capital Management, Victor Hagani.
Okay.
And another friend of mine, Ewan Kirk, wrote a really good kind of follow-up paper on it. But you've got a coin flipping contest. You've been told that you have a 60% chance of winning if you bet on heads every time. And he really wanted to see whether people sized accurately, because if you bet too much of your bankroll on that, you will still go bankrupt. There's actually kind of a formula, the Kelly formula, for correctly sizing your bets that is a kind of quant trader idea or a gambling idea. But so he wanted to see how close to like the Kelly optimal bet regular people came to, and he was shocked because he found that a lot of the time there were people, and after a long run of heads, they would bet on tails because they just felt it's time for tails to come up, you know? And there's sort of a thing where we want to express ourselves, like, or prove our abilities, and often that's harmful, you know? Like when you've been told the winning strategy, a lot of people can't stick with the winning strategy.
They go with the losing strategy because they go, I just want to be different, or I want to be.
Yeah.
Maybe they think it's time for tails. It's time
for a change, yeah, and they sort of feel that will prove that the return is about them rather than that it's sort of a return that they're harvesting. And in the real world, like even all of my quant trading, it's about harvesting returns. Like I find a return stream. It's a risky return stream always, by the way. There's no such thing as a risk-free high returns.